The only way to trade is by looking at the structure and identifying liquidity, identifying your draw on liquidity, where it is present, right? And I'm going to teach you a very simple approach on how you can achieve the exact same model that I use and how I identify the structure, the order flow, and how I actually identify the draw on liquidity, right? It's very easy. I'm going to teach you entry patterns. I'm going to teach you the entire model on how I would trade if I could only trade one strategy for the rest of my life. All right. And I've taught this before on the channel and in my course, but I'm going to go into a bit more detail in this video. So all I ask from you in return is that you hit that subscribe button, as it's going to motivate me to make more educational content for you for absolutely free. So without wasting any more time, let's get on with the video. So the very first thing that we have to look at is the structure, right? So price moves in two ways. So there is a trending market, right? Which is, you can see this. Now the actual price is not going to move like this all the time, but this is what on average the trending market would look like. It will be making clean lower lows, lower highs, lower lows, lower highs, and similarly higher high, higher low, higher high, higher low, right? This is one way the market moves. The other way is a ranging market, right? So this is how price moves, right? We have a trending market and then we have a ranging market. Now, ideally, what we want to do is we want to trade with the trend when the trend is clean. We do not want to be taking our trades during the ranging market, because that's going to be seek and destroy profile. And you're going to get stopped out again and again because you don't have a clear direction, right? So to identify the structure, to identify the trend, right, we have to look at the structure first, right? So if we are continuously making lower lows, lower highs, lower lows, lower highs, then the structure, the order flow is bearish. So tell me one thing, would it be wise to long and take a reversal from here even though the trend is already bearish? Or it would be wise to take trades with the trend, take continuation trades, right? So the obvious answer is that you should be trading with the trend, right? That is what a normal, like a 5-year-old baby would think, like, right? So when you have identified the order flow, and I'm gonna teach you a very easy way to identify the order flow. So let's suppose that you open up a pair, right? Whether it's Euro USD, GBP USD, within 4 or 5 seconds, you should be able to identify the current direction of the market. Yes, you have to look at the structure. So the number one rule, if you are breaking lower lows, right, then that is a potential sign that the momentum is to the downside. So we have lower low here, that gets broken. Then we're going to wait for price to come into a bit of premium zone, and then we can look to take our entries from there. Similarly, we wait for price to come into premium so we can take our trades. But I'm going to teach you the exact way I approach this. I'm not going to just tell you to take your entries from auto blocks, and that's not how it works. We're going to go deep into time frame alignment. We're going to go deep down into how to actually trade with structure and liquidity, because liquidity is very important, right? So there are two types of liquidities that we're going to be focusing on, and we're going to be using them to take our trades, right? So the number one rule that you have to understand is there are two types of liquidities, right? We have internal range liquidity and external range liquidity, right? So let's assume that the structure is to the upside and we've been continuously making higher highs, higher lows, higher highs, higher lows. Now, any fair value gap in the discount, right, is considered to be a internal range liquidity, right? So that is where price will rebalance itself to continue higher most of the time. All right, price is only doing two things. It's seeking external range liquidity, and it's going and rebalancing itself into internal range liquidity, and also it is going from internal range liquidity to external range liquidity, because price, if it wants to go up, it has to come back and rebalance itself into a fair value gap. That is very basic information. So how would I trade with the trend? How would I trade with the structure, right? If I see the structure is bullish, then there is no point for me to take reversal trades, because that's going to hurt me in the long run. So what I want to do is I want to trade with the trend. So any high and any low is called external range liquidity, right? Any high and low is called external range liquidity. Any fair value gap in the discount, preferably, basically any fair value gap in this leg could be considered internal range liquidity. But what I like to do is I wait for price to come back into discount after a market structure break. So we have a break of structure here. Then I'll wait for price to come into the discount zone by using the dealing range low and dealing range high. Now I'm waiting for price to come back into the internal range liquidity, also known as fair value gap, that is in the discount, right? Now, let's suppose, now the very important thing, the very important part of the strategy is time frame alignment. So what I would be doing is I would be looking at the structure at the 4-hour time frame. So my higher time frame is 4-hour time frame. This is what I'm looking at, all right? My entries are going to be either on the 15-minute time frame or 1-minute time frame. I'm going to get into that later in the video, but most of the time my entries are going to be on the 15-minute time frame. So we have a break in structure. Now I'm waiting for price to come back into my internal range liquidity, right, on the 4-hour time frame. So let's assume price comes back into this internal range liquidity. Now we need to see a confirmation. We need to see a confirmation of some sort that's going to tell us that the price is now going towards the external range liquidity, which is over here and also here as well, right? Because as I said before, every high and low is called external range liquidity, and price only does two things. It goes from external to internal or from internal to external. Very basic stuff. So now on the 4-hour time frame, we have our price inside this fair value gap, which is internal range liquidity. Now we're going to drop down to 15-minute time frame to look for a market structure shift, but we're not going to take our entry after a market structure shift if one of this criteria is not met. So one of these criteria are not met, right? So when we get a market structure shift on the 15-minute time frame, I want to see some sort of SMT divergence. That is very important because we are only using 2 time frames, right? So we also need a bit of more confirmation because you can get easily faked out by this fake market structure shift. Now to identify a real market structure shift, we have to look for SMT divergence either here, or if price goes up, right, after market structure shift, we can look for SMT along the way. When price is going towards this high over here from this internal range, we can look for SMT along the way. So for example, let's say on your USD, right, we failed to take out this low over here, but on GBP USD, we took out this low over here. So now that is your SMT. And if we are in a PD array of some sort, then I can basically enter directly, or I would look for a change in the state of delivery at around this level. So what I would do is I would look at the continuous downside candles, and then I would wait for price to close above those downside candles, right? And that is your change in the state of delivery. From there onwards, I'm basically taking my entry, right? I'm targeting this external range liquidity. Very, very easy stuff. Now, if you do not want to look for SMT divergence and you think that it's complicated, then we are going to use 3 time frames. And the reasoning behind this is, let me tell you why. So let's assume that price comes back into your 4-hour internal range liquidity. And the very first step on the 15-minute time frame, we look for a market structure shift, right? Now that is your confirmation 1. Now, instead of looking at SMT, what I would do is I would mark out a PD array inside this 15-minute leg, and I will wait for price to come back into the discount, into some form of PD array, and then I will drop down to 1-minute time frame, right? So 4-hour, 15-minute, and 1 minute, right? So now we have this 15-minute structure, and price comes back into this 15-minute PD array, so we drop down to 1-minute time frame. Remember that, right? So now we are looking for a market structure shift on the 1-minute time frame, right? And then we can proceed to take our entry. So that's like 3 confirmations. We have the structure, we are trading with the trend, right? We are waiting for price to come back into our discount zone. We are looking to trade from a internal range liquidity, which is also the discount zone, right? And then we have a lower time frame confirmation and the lowest time frame confirmation, or an SMT confirmation, right? Similarly, it will look the same thing if you are trading in a bearish trend, right? Same rules apply. So now I'm going to give you guys some examples, and that is going to clarify each and everything. All right, so here is example one. Looking at Euro AUD on the 4-hour time frame. So previously we were bearish though, right? We were making lower lows, lower highs, lower lows, lower highs. But then from here onwards, you can see we have a higher high, higher low, higher high, higher low, higher high, higher low, right there. So the structure now is bullish. I do not care about this price action because I don't know which fair value gap is going to be respected. There's a fair value gap here, right? So it's just not easy to identify which fair value gap is going to work. But if you trade with the current momentum, the current volume, the current order flow, right? Because we're looking at the 4 hours, so this is a big structure change, right? So now we have taken out external range liquidity here. So where is price going to balance itself? If you notice here, we have this fair value gap, right? So if I play this through, you're gonna see that price comes back into this fair value gap, and then we have a sharp reversal. But I'm gonna go to the lower time frame and I will show you how I would have taken an entry. So we tap into this. If we use our fib from this low to this high, you can see this fair value gap is below the discount. It is in the discount, right? So now if I go to the 15-minute time frame, the very first step is that we have to look for a market structure shift, right? So we have lower low, lower high, lower low. Price taps into our fair value gap, and then what do we have? We have a market structure shift. Now what does price do? When we have a market structure shift, it's going to come back into the discount to some form of PDR rate. Could be breaker block, could be a fair value gap. Over here, what do we have? We have a fair value gap. So now we're not going to be looking at SMT for this. We're just going to be looking at the 1-minute market structure shift confirmation and then an entry. So after a bit, price, if I play this through, it goes up, engineers liquidity, and right there, what do you see? Price taps into this fair value gap, and notice this, we still have our draw on liquidity intact, which is external range liquidity. So this is very important. If before your entry your target is hit, then the setup becomes invalid, and then we will look for another setup. And now outside with all these pairs and assets, right, you can easily find 3, 4, 5 high probability setups per week. So we tap into this 15-minute fair value gap. This one was filled, right, below the 50%, so that is not a valid fair value gap anymore. So price comes back into this. What we're gonna do is let's go here, right, and let's drop down to 1-minute time frame. From here onwards, what we are looking for is a simple market structure shift. And right there, what do we have? We have a market structure shift. So now I have 3 confirmations, right? So I am easily going to take my entry from this fair value gap, put my stop just below here, 17 pip stop loss. It's nothing, right? And I'm going to target this high over here, which is the 4-hour high, right? We have liquidity here. We have structure telling us what to do. The market's going to tell you what to do, right? So it's going to provide you with clues, and you're going to see how beautifully this works out. So we get a tap into this fair value gap, and let's go to the high time frame a bit so it's fast, right? And price consolidates for a bit, right? Engineers more liquidity, sweeps more liquidity, right? Because in order for price to go up, it needs to seek liquidity, right? And then after some time, you are going to see that price creates another higher high on the 4-hour time frame. But you can see how accurate and pinpoint our entry was, right? So let's move on to the next example. All right, guys, before moving on to another example, if you're looking for a reliable prop firm and a trusted one, then I would highly recommend My Funded Futures. I have personally traded with them, and I believe it is the best prop firm out there, right? We get payouts. There are no delays in payouts and everything. So if you want to buy a challenge with them, you can get a discount if you use the code FAZSMC, and if you trust me, then you should trust this prop firm. All right, because I have affiliated with them, and there is no reason for me to affiliate myself with them if I don't think that this prop firm is worth it, right? So the link is in the description. You can use the code FAZSMC and you'll get a discount. Also, if you want to trade live with me, there's a link to my course and my Discord. I trade every single week. So if you want to do, got some proof and everything. I rarely promote my things, right? But sometimes, it's okay if I'm providing value, then why not? So got a bunch of students that got funded, got a video explaining how I can, make you a profitable trader, live trading, market analysis, strategies that actually work, some proof, and blah, 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 blah. So now let's move on to another example. All right, guys, so here is another example, and you can see the structure is clearly to the downside, right? We are going down and down and down. So I'm not gonna look for reversal trades unless I get like 3 market structure breaks to the upside, like this, clean breaks, right? And then I can, change my directional bias. So right now, what do we have here? We have this fair value gap, right? So we are creating structure to the downside. Price comes into this fair value gap and then it pushes down. But how you would have taken your entry is the real question. So let's zoom in a bit and see how you would have done that. So going to the 15-minute time frame from 4 hour, and now you can use daily, 1 hour and 5 minute as well. But if you want to scalp, then this is best time frame for you, right? So we're gonna use SMT for our confirmation, and we're gonna only use 2 time frames, right? So we are in the PD array, and then we get a market structure shift, right? Right there with the wick. It's telling me that volume is to the downside, so I'm gonna consider this as a market structure shift. Now, notice here clearly, we have a high, and then another sweep of this high. So on NZD USD, right, we swept liquidity here, and then if you look closely, the same high, if I zoom in a bit, price failed to sweep the liquidity or this high in right? If you look at it here, it failed to sweep this high over here. So what is this telling me, right? Now ideally I want to be trading AUD USD because it is a stronger pair, but we are looking at NZD, right? And we have a clean market structure shift here, right? Unlike AUD USD, because we have a bunch of liquidity here, so I cannot trust this. But this one is a much better pair in this scenario. So break in the structure, we have SMT, right? And then we have this fair value gap, right? And we get a tap into this fair value gap, and right, you get SMTs along the way as well, right? So if you missed this entry, right, you can see that we have an SMT here, somewhere around here, right? Let me just see where. Okay, with this high probably, yeah, with this high right there. Yep. So I'm just gonna right there. Perfect. So you can see we swept liquidity on NZD USD, right? But we failed to do so on AUD USD. This high was not swept on NZD, but on NZD USD we swept this high, right? So then you could have taken your entry after a change in the state of delivery. Right here we have a break, right? And then we have a fair value gap. So consecutive bullish candles, body closes below it. That's your change in the state of delivery. Fair value gap right there. That is your entry, right? And you can see how price goes down and takes out this original consolidation. So basically it's all structure and liquidity, guys. I really do hope you guys enjoyed it. If you want to learn more about the strategy, you must watch my detailed video on external and internal range. Otherwise this will not work for you. So click here right now and go watch this video, because if you don't, then there's a chance that this will not work for you.